Execution. Principle 15. Market participants should identify and resolve trade discrepancies as soon as practicable to contribute to a well-functioning FX market. Market participants should have effective policies and procedures designed to minimize the number of trade discrepancies arising from their FX market activities and should manage such discrepancies promptly. Market participants acting as prime brokers play a unique role in assuming the credit risk of authorized trades executed by their prime brokerage clients. Where the client identity is known, prime brokerage clients and executing dealers are responsible for resolving trade discrepancies to achieve timely amendments and matching of trade terms through the prime broker. When anonymous market access is provided, the access provider should assist in the resolution of trade discrepancies. Principle 16. Market participants acting as voice brokers should only employ name switching where there is insufficient credit between parties to the transaction. Voice brokers that undertake name switching should have proper controls and appropriately monitor such transactions, have proper approvals, execute and book such transactions as promptly as possible, consistent with the appropriate protection of related confidential information, maintain proper records of such activity. A dealer should not solicit or accept favors from a voice broker for switching names. Principle 17. Market participants employing last look should be transparent regarding its use and provide appropriate disclosures to clients. Last look is a practice utilized in electronic trading activities whereby a market participant receiving a trade request has a final opportunity to accept or reject the request against its quoted price. Market participants receiving trade requests that utilize the last look window should have in place governance and controls around its design and use consistent with disclosed terms. This may include appropriate management and compliance oversight. A market participant should be transparent regarding its last look practices in order for the client to understand and to be able to make an informed decision as to the manner in which last look is applied to their trading. The market participant should disclose, at a minimum, explanations regarding whether, and if so how, changes to price in either direction may impact the decision to accept or reject the trade, the expected or typical period of time for making that decision, and more broadly the purpose for using last look. If utilized, last look should be a risk control mechanism used in order to verify validity and/or price. The validity check should be intended to confirm that the transaction details contained in the request to trade are appropriate from an operational perspective, and there is sufficient available credit to enter into the transaction contemplated by the trade request. The price check should be intended to confirm whether the price at which the trade request was made remains consistent with the current price that would be available to the client. In the context of last look, the market participant has sole discretion, based upon the validity and price check processes, over whether the client's trade request is accepted or not, leaving the client with potential market risk in the event the trade request is not accepted. Accordingly, and consistent with related principles in the Global Code, last look should not be used for purposes of information gathering with no intention to accept the client's request to trade. Confidential information arises at the point the market participant receives a trade request at the start of the last look window, and use of such confidential information should be consistent with Principles 19 and 20 on information sharing. Market participants should not conduct trading activity that utilizes the information from the client's trade request during the last look window. Such trading activity would include any pricing activity on FX e-trading platforms that incorporates information from the trade request and any hedging activity that incorporates information from the trade request. Such activity would risk signaling to other market participants the client's trading intent and could move market prices against the client. In the event that the client's trade requests were subsequently rejected, such trading activity could disadvantage the client. This guidance does not apply to an arrangement that features all of the following characteristics. 1. An explicit understanding that the market participant will fill the client's trade request without taking on market risk in connection with the trade request by first entering into offsetting transactions in the market. 2. The volume traded in the last look window will be passed on to the client in its entirety. 3. This understanding is appropriately documented and disclosed to the client. It is good practice for market participants to be available to engage in a dialogue with clients regarding how their trade requests have been handled, including the appropriate treatment of information associated with those trade requests. Such dialogue could include metrics that facilitate transparency around the pricing and execution of a client's trade requests and assist a client in evaluating the handling of its trade requests. In order to evaluate whether the execution methodology continues to meet its needs over time. Principle 18. Market participants providing algorithmic trading or aggregation services to clients should provide adequate disclosure regarding how they operate. Market participants may provide clients with algorithmic trading services that use computer programs applying algorithms to determine various aspects, including price and quantity of orders. Market participants may also provide aggregation services to clients. Services that provide access to multiple liquidity sources or execution venues, and that may include order routing to those liquidity sources or venues. Market participants providing algorithmic trading or aggregation services to clients should disclose the following: a clear description of the algorithmic execution strategy or the aggregation strategy and sufficient information to enable the client to evaluate the performance of the service in a manner that is consistent with appropriate protection of related confidential information. Whether the algorithm provider or the aggregation service provider could execute as principal. The fees applicable to the provision of the services. In the case of algorithmic trading services, general information regarding how routing preferences may be determined. In the case of aggregation services, information on the liquidity sources to which access may be provided. Market participants providing algorithmic trading or aggregation services should disclose any conflicts of interest that could impact the handling of any client order, for example, arising from their interaction with their own principal liquidity or particular commercial interests in trading venues or other relevant service providers, and how such conflicts are addressed. Market participants providing algorithmic trading services to clients are encouraged to share disclosure information in a market-wide standardized format, for example, by aligning with the structure of the GFXC's FX Algo due diligence template where appropriate to allow clients to more easily compare and understand the services. Such disclosure information should be easily available to both existing and prospective clients, for example, by being shared bilaterally or made available publicly on the provider's website. Market participants providing algorithmic trading services to clients are encouraged to disclose pertinent information to be used for the purpose of transaction cost analysis in a market-wide standardized format, for example, by using the GFXC's transaction cost analysis data template. Additional data should be provided if it is considered useful. Clients of algorithmic trading providers should use such data and disclose information in order to evaluate, on an ongoing basis, the appropriateness of the trading strategy to their execution strategy. Clients that use an aggregator to access trading venues should understand the parameters that will define the prices displayed by the aggregator. Market participants providing algorithmic trading or aggregation services should provide services that perform in the manner disclosed to the client.